Okay, so picture this for a second. You're sitting at your kitchen table, it's a random Tuesday night, and you're doing that thing where you log into your brokerage account not because anything exciting happened, but just out of habit. Kind of like checking the fridge even though you know nothing new is in there. And you glance at the numbers. Contributions this year, about $6,000. Growth this year, $11,000. And you just sit there for a second, honestly a little stunned because the math doesn't feel real. Your money made more money than you did by actually putting money in. That's a strange sentence to say out loud, but it's happening to more people than you'd think. And if it hasn't happened to you yet, it eventually will, if you stay in the game long enough. My name is Rick, and I spend way too much time thinking about money, about the weird psychological moments where your relationship with your own finances quietly shifts, and about why some people cross this invisible line years before others do, even when they started with similar incomes. Because here's the thing, there's a moment, and it's different for everyone, where your portfolio stops being this passive little side project you feed every payday, and starts becoming almost like a coworker, a silent one. One that doesn't take breaks, doesn't ask for a raise, and somehow starts outperforming you. And once you see that moment clearly, once you actually understand the mechanics behind it, it changes how you look at every dollar you save from here on out. It changes how patient you're willing to be. It changes what rich even means to you. So in this video, we're going to talk about what actually happens when your investments start paying you more than you're contributing. Why it happens, when it tends to happen, what it feels like. And honestly, the mistakes people make right before and right after they hit that point. Because a lot of people get close to this moment, and then, out of fear or impatience, they wreck it. And I don't want that to be you. So let's start with the obvious question. What actually is this moment? Financial folks sometimes call it the crossover point. And honestly, I think that name undersells how weird it feels when it actually happens to you. Here's a simple way to picture it. Let's say you're contributing $500 a month to your investments. That's $6,000 a year, roughly. In year one, your account might grow by, I don't know, $400 from market returns. Basically nothing. Your contributions are doing almost all the heavy lifting. You're the one pushing the boulder up the hill. But keep going. Year 5, your account is bigger, so that same average return is now producing, say, $2,000 a year in growth. Year 10, maybe $5,000. And at some point, and this is the part that sneaks up on people, the growth line crosses above the contribution line. Your money starts earning more in a year than you're physically putting in. This is just compounding doing what compounding does, but there's something almost emotional about watching it happen in your own numbers, instead of like a textbook chart. Because for years, saving felt like the entire engine. You were the engine. And then one day, quietly, without an announcement, your portfolio becomes the engine, and you're more like fuel. Necessary fuel, sure, but not the only thing making the car move anymore. Why does this matter to you? Because most people give up right before this point. They look at years 3 and 4, see modest growth, and think, this isn't working fast enough. And they either stop contributing or they get impatient and start chasing riskier stuff trying to speed it up. But the years right before the crossover are always the least exciting. That's just the nature of the math. Early compounding looks flat, almost insultingly flat, and then it bends upward in a way that looks almost unfair later on. The actionable piece here is simple, but people resist it constantly. Track your contributions versus your growth every year, separately. Most brokerage apps let you see this, or you can just log it yourself in a spreadsheet. When you can literally see the line where growth starts outpacing your deposits, the discouraging years make a lot more sense, because you know exactly what you're waiting for. Alright, so let's talk about why this crossover point happens at wildly different times for different people, because it's honestly not just about how much you make. Everyone's heard the snowball metaphor for compounding, right? The little snowball rolling down the hill picking up more snow. Fine analogy, kind of overused, but I want to add something to it. The snowball isn't actually made of snow, it's made of time. The size of the hill, meaning how many years you let it roll, matters more than how hard you throw the snowball at the start. Let me give you a comparison, because this is where it gets kind of uncomfortable for people in their 30s and 40s. Someone who invests $200 a month starting at age 22 is very likely to hit their crossover point, where growth exceeds contributions, years, sometimes even a full decade, before someone who invests $600 a month but doesn't start until 35. The higher contributor is doing everything right by conventional wisdom. They're saving 3 times as much every single month, and they can still lose the race to time. That's not fair, and honestly, I don't love saying it, but it's true, and pretending otherwise doesn't help anybody. Why? Because compounding needs laps around the sun. It needs the returns from year 1 to sit there and generate their own returns in year 2, and those to generate returns in year 3, and so on. There's no contribution amount that fully substitutes for that stacking effect. It's less like filling a bucket and more like planting a tree. You can't really rush a tree into being 20 feet tall by watering it extra hard for 1 week. It just needs seasons. Now, if you're listening to this and you're already 38 and feeling a little sick to your stomach, let me say clearly, this is not a reason to give up. It's a reason to start immediately. Because every year you wait is a year the tree doesn't get to grow. The takeaway isn't, "It's too late for me." The takeaway is that the cost of waiting another year is way higher than people think, because that lost year would have been compounding for decades, not just for 1 year. And honestly, I think this is why the phrase, "it's never too late to start," gets thrown around so casually, almost like a bumper sticker, when really it deserves a lot more weight than that. It's true, but it's true in a specific way. It's never too late to start the clock, but starting the clock later does mean accepting a smaller snowball at the bottom of the hill, or accepting that you'll need to throw more snow at it along the way to make up the difference. Neither of those is a tragedy, but pretending time doesn't matter, pretending contribution amount alone can fully close that gap, that's the part that sets people up for disappointment later. Let's get a little more personal for a second, because the psychological side of this is honestly more interesting to me than the math. People describe the first time they notice this crossover in kind of similar ways. There's this weird mix of pride and disbelief. Some people feel almost guilty, like they didn't earn this money, the market just handed it to them. I've heard people say things like, "It feels like cheating," which I actually find kind of funny, because no, you didn't cheat, you paid the price of patience for years while everyone else was spending on stuff that felt better in the moment. But there's also a strange discomfort that comes with it, and nobody really talks about this part. Once your portfolio starts generating serious money on its own, some people get nervous. They start checking the account more. They get anxious during downturns in a way they never did before, because now there's real money on the line, not just contributions they can mentally categorize as savings I haven't spent yet. Losing 10% of a $15,000 portfolio feels different than losing 10% of a $150,000 one, even though the percentage is identical. The zeros get heavier. This matters because a lot of people, right around this exact stage, make an emotional decision that costs them years of progress. They panic sell during a downturn because the dollar amounts finally feel real to them. Or, on the flip side, they get overconfident and start taking on way more risk because, hey, the portfolio's clearly working, so why not push it harder? Both reactions come from the same place: the emotional shock of watching your money behave like it has a mind of its own. The advice here is almost boring, but it works. The moment you notice your growth outpacing your contributions, that's exactly when you should be reviewing your risk tolerance and asset allocation, calmly, on a normal Tuesday, not during a market crash when your amygdala is running the show. Decide in advance how you'll behave when the portfolio drops 15% in a month, because it will at some point, and you want that decision made by calm you, not panicked you. Here's something that surprises a lot of people once they cross this threshold. Your relationship with contributing changes. It sounds small, but it isn't. Before the crossover, contributing money feels like the entire point. It's the whole show. You feel the sacrifice every single time, right? Skipping the vacation, driving the older car a bit longer, packing lunch instead of grabbing takeout again. Every dollar you put in feels heavy because it's carrying all the weight of your future growth. After the crossover, something shifts. Your contributions start to feel more like topping off a tank that's already mostly full and running on its own fuel. You're not the sole reason the number is growing anymore. And weirdly, this can make people either more relaxed about spending, which is fine in moderation, or it can make them almost obsessive about protecting what's been built, because now there's this sense of, wait, I don't want to mess up something that's finally working. I think the healthiest version of this shift is realizing that your contributions are now doing a different job than they used to. Early on, contributions are the primary growth engine. Later, contributions become more like an insurance policy against bad market years, a way to keep dollar-cost averaging into dips, and a way to keep your habits sharp even when the portfolio could technically coast for a while on its own. You're not less important. Your job just changed, kind of like a parent whose kid grows up. You're not doing everything for them anymore, but you're definitely still showing up. The practical takeaway here is to resist the urge to stop contributing once growth starts outpacing your deposits. That's honestly one of the most common and most expensive mistakes people make. They see the account growing nicely on its own and think, I can ease off now. But continued contributions during this phase are what protect you during the inevitable rough years, and they're also what keep the compounding math scaling instead of plateauing. One more thing I want to get into, because I think it quietly ruins people's motivation more than almost anything else. Comparing your crossover point to somebody else's. You'll see it online constantly. Someone posts their portfolio hitting six figures at 26, or their dividends covering their rent at 31, and it's easy, honestly almost automatic, to feel this little sting of, why isn't that me? But here's what those posts almost never show you. The starting income, the family help, the specific market years they invested through, the debt they didn't have, or the debt they did have and just didn't mention. Your crossover point depends on so many personal variables. Your income, your expenses, when you started, what you invested in, what the market happened to do during your specific years. That comparing your timeline to a stranger's is a little like comparing two different rivers and asking why one reached the ocean faster. Different lengths, different terrain, different rainfall. It's not really a fair comparison, and it never was. What actually matters, and this is the part I'd really want you to walk away with, is your own trajectory relative to your own starting point. Are you further along than you were last year? Is the gap between your contributions and your growth narrowing over time, even slowly? That's the number worth watching, not some stranger's highlight reel. And here's a small, almost silly habit that helps with this more than people expect. Stop checking your portfolio against the internet and start checking it against a folder. Literally, keep a simple note. Once a year, same month, same day if you can manage it. And just write down your contributions and your growth for that year. That's it. No comparison to strangers, no comparison to the market average. Just you against you, 12 months apart. Over enough years, that little annual habit becomes its own kind of proof, a paper trail that shows you, in your own numbers, exactly how the crossover happened, rather than relying on some fuzzy memory of when things started feeling different. So let's bring this back together for a second. The moment your portfolio starts paying you more than you invest isn't some magic trick or some secret formula that only certain people figure out. It's just time and consistency, quietly compounding in the background while you go on living your life, going to work, making dinner, worrying about normal stuff. It happens slowly, and then, kind of like the crossover math we talked about, it happens all at once, in a way that can genuinely catch you off guard the first time you notice it. And look, whether you're years away from that moment or you're already living in it, the emotional part matters just as much as the math. Don't give up in the flat, boring early years, because those years are doing more work than they look like they're doing. Don't panic when the numbers finally feel real enough to scare you a little. And please don't measure your timeline against somebody else's highlight reel, because you're not running their race, you're running yours. Honestly, I think the most beautiful part of this whole thing is that it rewards patience in a world that constantly begs you to be impatient. Every dollar you leave alone today is quietly negotiating on your behalf for years you haven't even lived yet. That's kind of wild if you actually sit with it. So wherever you are on this timeline, keep going. Keep feeding the machine, even after it starts feeding you back. Your future self is already thanking you for it, even if you can't hear it yet. If this made you think differently about your own numbers, stick around, because that's exactly the kind of stuff we dig into around here. Now, if you found this valuable, Make sure to press that like button, comment your thoughts, and subscribe to this channel. Thanks for watching, and I will see you in the next one.